Good morning, everybody, and thanks so much for joining us today for the monthly edition of The Balance Perspective. As usual, my name is David Levinson of Net Group Investments, and we're joined on the line by Ian Power, the CIO of Truffle Asset Management. Ian, as always, thanks so much for joining us this morning.
Morning, David, and thanks to everyone who's joining us on this call.
Ian, you will be proud of me. I got my second vaccine shot recently, but I am feeling a little bit flat, so excuse me as I sip on my coffee a little bit during the course of today, just to make sure that I am mentally and physically present. I was also checking my emails, and it is the 12th edition of The Balance Perspective, so we've been going for a full year. It is our anniversary. And two noticeable things, the first being that, Ian, you are still picking up my calls, which I think is amazing in and of itself. And it's also the first time I've been teased into using your name as a pun for the title of the session. So I do apologize. I did fall victim to that eventually. I'm going to spare you my usual couple of minute monologue at the beginning of today's session. I want to get through quite a bit. So first things first, to the meat of it, what has been the main cause for the spike in energy prices that we have seen recently?
Yeah, thanks, David. I think, I guess multiple of reasons, some of them structural and some of them cyclical. Firstly, we've had, I guess, some impacts of global warming around the world, which have reduced wind in certain areas, rain, for example, in China, in Brazil, in Scandinavia, which has, pretty much a confluence of all these factors has resulted together with limited supplies of gas in Europe is the energy crisis rolling around the world that we've seen. And I think, to the extent that then China and India also looking for more coal on the back of their own initiatives to support coal-fired power stations, given the lack of alternate baseload capacity, has pushed up the energy complex in totality. So what we've seen is we firstly saw coal prices run very hard. That's thermal coal prices. That then pulled up natural gas prices. And there's a little bit of a political chess match being played between Russia and Western Europe. And then in addition to that, then obviously oil getting the bid from a global economy, which is continuing to open up, as well as the arbitrage between energy producers and consumers using oil as a cheaper feedstock or diesel as a cheaper feedstock in terms of power generation. So I think lots of factors, some of them are cyclical, but some of them are also structural. And I think some of the structural factors really relate to a discussion that we've had for quite some time, which revolves around ESG. And I think ESG and the funding and expenditure on fossil fuels really is resulting in a situation where you have seen very little CapEx, capital expenditure, going into reserve replacements from lots of the big oil companies. So just to put it into perspective for the guys on the call, the last sort of, or the 5-year period from 2011 to 2015, relative to that period, we are running about $700 billion lower in terms of capital expenditure for the 40 biggest oil companies in the world. So oil company boards are sitting there and saying, well, we don't know what the future for fossil fuel demand looks like. And, how can we justify putting shareholder funds or cash flows back into finding new product when we also by 2050 have to then start really phasing out many of these fossil fuels. So I think you've got a situation where demand for these fossil fuels is still relatively sticky, yet the pivot from an ESG point of view and focus is resulting in a lack of investment in the space, which is now starting to result in supply, potentially over the medium term, not being able to keep up with demand.
Yeah, thanks, Ian. And I don't want to get too much into the debate of gas as a transition fuel, which it has been highlighted as. There are obviously proponents for it and those who are against it. But I think it was in the September edition of The Balance Perspective, you highlighted China pivoting to more of an inclusive and a greener economic roadmap. And I imagine this does have some implications for gas.
No, I think that's right. And I think, gas has 55% of the carbon footprint that, for example, coal would have. So it's a much cleaner fuel. And certainly to the extent that one has the ability to use that as a feedstock, or at least the generation capacity for your base load. I mean, clearly that is attractive. Having said that, you've still got China, where coal makes up about 58% of their base load power, and India as well, where its coal is significant, which means you're still going to see demand for those coal-fired power stations, notwithstanding the fact that there is this pivot away to either sustainable or less carbon-intensive power generation mechanisms. But we do see gas and LNG taking a bigger share in terms of the global footprint from a cleaner dirty shirt perspective in terms of fossil fuel power and energy production.
And then on that topic, we're obviously experiencing the hangover of the COVID-induced supply chain disruptions, pent-up demand, the loose monetary policy, just to name a few, all impacting our inflation outlook. These high energy prices, what could it mean for inflation, and has it affected your view at all?
Well, I think what we are seeing is and we're likely to continue to see the supply of these fossil fuels not keep up with the recovery in demand. And I think that really talks to the earlier point I made around ESG and the funding for some of these assets, and also the lead time, David, that it takes to bring many of these projects online, whether it's a new gas pipeline or gas deposit, or for that matter, oil. So I think the lead times are long, and companies are fearful of what future demand looks like. So I think the reality is, even though there is a cyclical spike in these energy prices, we're likely to see higher prices for longer over the medium term because of the fact that supply can't keep up. And I think that really does then feed into, from a pricing point of view, and exacerbate some of the other cost pressures that many companies around the world are dealing with. And there is a potential here that the inflation pathway or trajectory could be looking slightly higher versus what was perhaps expected 1 or 2 years ago. So I think there is perhaps a little bit of a concern around that. And, the reality is, whilst we and the world might want to pivot towards sustainable energy, and we got COP26 coming up, the reality is there's lots of spend that needs to take place in infrastructure, in grids, in sustainable energy production, in storage, until or before we can get to that point. So I think, getting back to what I said earlier, demand for fossil fuels is pretty sticky, and it doesn't fall away that quickly. And because high prices are no longer incentivizing more supply because of those issues, it means that the risks to, I guess, pricing pressures from energy certainly appear to be on the upside.
And just to bring in some of the numbers, I think I was reading an article the other day where primary energy is still globally around 83% reliant on coal and your typical fossil fuels. The Economist also had an article last month, or at least a couple of weeks ago, saying that coal inventories in the likes of China or India are something below 50% of where they're usually at as well. And then leading into COP26, I believe renewable energy spend is around 40% or 50% of actually where it needs to be to make sure that there is that smooth transition without those energy disruptions. And it's quite interesting to talk about energy disruptions at a global level and not just at Eskom. So we're not the only ones struggling on that front. And I'm sure everyone's yelling at their screens for this question to come up. Last but not least, this will have implications for different sectors, both globally and locally here in South Africa, and even companies more specifically as well. So I don't know if you have any high-level comments on which sectors and companies will be affected by this higher energy prices, because I imagine some will benefit and some will also suffer.
No, I think that's right. I think there are some countries which are more energy intensive in terms of their economies, and where that is a bigger factor of production and where they don't have that access to it themselves. Clearly, it is going to be either an additional cost for businesses and to the extent of consumers insofar as their own petrol or gas or whatever the fuel is that they're using, there is an additional tax that is certainly going to be on their disposable income. So I think, businesses which really are able to distribute their product or are able to minimize those impacts in their value chains are likely to be better off than others. But I think it's fair to say that, certainly from a consumer point of view, consumers are going to be facing a little bit of a bigger bite out of their wallets. And, ultimately the products need to get onto the shelves from a retail point of view. So that will no doubt feed its way through the system. And, the one big positive, David, that I will say what this does bring about is from a power generation point of view, as these prices and prices of the feedstock continually move up, the proposition or the attractiveness of some of the sustainable energies, the solar PV stations and panels become more and more attractive. So I guess, to the extent that there is a bit of a stick, I think there is also a carrot. And, we're seeing significant installations around the world where consumers are now moving to try and get themselves off the grid, or at least self-provide. And I think, this is a good thing in terms of where the world needs to move to, and also from a consumer affordability point of view, puts them in a position where they're less exposed to potentially the vagaries of these high price increases.
As always, thanks so much, Ian. These 15 minutes have absolutely flown by. I know you have quite a heavy schedule for today. So thanks so much for joining us, and we'll catch up with you next month for the final edition of 2021.
Thanks, David. And just thanks to everyone who has joined us on these calls, and hope you got some value or benefit out of it. Have a good day.
Cheers, Ian. Take care. So I was trying to type away a little bit as Ian was chatting there. So just some high-level highlights and comments from my side. Soaring energy costs and supply chain disruptions have unnerved markets. Although these may ultimately prove to be transitory, they may keep inflation levels elevated for another year or so, according to some of Ian's comments there. And this is the so-called transitory for longer inflation envisaged by the US Fed. Reduced capital expenditure in coal may well result in elevated prices over the medium term, as renewables still need to be scaled up significantly. Natural gas prices in Europe should reduce as Gazprom's Nord Stream 2 pipeline comes online in the next few months. And then across the Atlantic in the US, higher US rig counts should help reduce US gas prices over there. On that note, I think I was hearing towards the end of last week, our oil prices will go up by around 99 cents per litre here in South Africa. Many energy-related shares, including the global oil majors and miners exposed to coal, do not appear to be pricing in these higher energy prices just yet, and consequently this presents an investment opportunity as per Ian's comments. In fact, that also came through in the fund's quarterly commentary. So in a nutshell, that was the highlights for today's discussion. As always, thanks so much for joining us, and have a great day further. Goodbye.